Okay, guys, so based on any of the previous teachings that we've learned thus far, I'm sure there should be some questions. So, does anyone right now have any questions that they would like to bring forth?
Hello, good morning.
Manuel, yes, go ahead.
I did ask you on the chat about the throttle swing, if I spelled it right. The four candle, I guess, is one to the left and three to the right. Is that correct?
Is that a question you asked me about on a private or in the group?
Both on
When
private. Yeah,
okay, so you
yes,
asked
I did.
you asked me, is it spelled right? So no, it's not spelled right. You spell it with a fractal, fractal, not frattle, so fractal. And then you said, when we identify something like that, does this mean price is changing? So
Yes, that was my question.
okay, so we can open our chart here and have a look. So the answer to that question, Emmanuel, is it can mean that price is changing, okay, but it also doesn't mean that price is changing. So meaning that as long as there is a fractal swing in the direction of the order flow, then yes, it is likely that price may now be wanting to change. So if we look at it from a perspective of a lower time frame, when we get a fractal swing. So what is a fractal swing again, guys? A fractal swing is 4 candles. So we want to have a swing high, which is this guy over here.
Darren, sorry, we can't see your screen.
Oh dear. Let's see why that's the case. Just one second.
Thank you.
How about now?
Yeah, all good.
Yes, now we can see your screen.
Okay, perfect. So in terms of a fractal swing, as Emmanuel asked, he asked what essentially is a fractal swing and is that the identification of a price swing. So yes, it is an identification of a price swing, but it doesn't mean that every single price potential swing or fractal swing that you see is the change in direction, because obviously price has to move from one level of premium to a level of discount, or one level of discount to one level of premium, to the associated or potential PDA or point of interest that you will find on the chart. So for example, if we look at this lower time frame here on any pair like EU, for example, this is a fractal swing. Okay, now obviously looking in hindsight, it is a fractal swing, and you can see the price, didn't come up here. Well, it tried to, and then it didn't take out this high. But what makes this a fractal swing is the fact that there is one candle that is a low. The next candle over here is the highest candle that is the high, and then 2, 3, 4. So 1, 2, 3, 4. So 4 candles over here. So when we look at that, it is 4 candles, one to the lower first candle, then the highest candle, 3 and 4. So that is how the fractal swing works. 4 candles with the second candle being that swing point over there. So this over here, if we look here, so one candle that makes a low, then another candle, candle 2 over here makes a lower low, and then candle 3 and candle 4 over here. So this candle over here, this one here, not the one that makes the actual low, this is what's making the fractal low, but this second candle, when it closes, this green candle over here, when this one closes, when the fourth candle closes, that is making a fractal swing. Why? Because candle 1, 2, 3, and 4. We need 4 candles to make a swing over here. So again, over here, fractal swing, candle 1, 2, 3, 4. So candle 4 must obviously close much lower, or if it's in reverse for a buy, than candle 3. and candle 2. That's what makes it a swing of price. So candle 1, 2 makes a high, 3 and 4. Okay, and obviously if it's relating to a higher time frame, so like let's look at what price did over here when it traded into this high and made a high here. Now the only reason or only way you'd know that that's a potential fractal swing, because it's all very well you can look at it from a 5-minute or 1-minute or anything lower time frame, but the higher time frame associated to the lower time frame is how you know that there could be a fractal swing that could occur. Okay, so when you go to the higher time frame, you're going to look, is that an area of a potential fractal swing? So over here, when price traded higher, it's trading into what we refer to as the order block over here. So last candle up, and then price sells, comes back into the order block, and then boom, price sells again over here. So this is that fractal swing point. Now there's an order block there. Let's see what's on the daily. So you don't know this yet, but what you will learn is that this over here is a rejection block over here, okay, because it's got a wick inside here, and there's, we'll go into details as to why that's a rejection block at a later time, possibly on Friday, but that is a rejection block based on a daily time frame. 4-hour time frame tells us that this is an order block, so it's trading into the order block and then price sells. So the order flow was bearish anyway. So all I'm really saying here from this is understanding what we learned about last week Friday about the fractal swing points, which is 4 candles. We need to associate that the potential fractal swing that may occur will occur at a higher time frame. So obviously you're going to be using like whatever time frame you use to enter, 1 hour, 30-minute, 5, 15, 1 minute, whatever chart time frame you're going to look or identify the fractal swing. Make sure that that fractal swing point is, there's a reason why there should be a fractal swing there. Like you wouldn't just sell there. Obviously it's come from a low and then it's come to a high. So from this swing high to that swing low, or this swing low to this, this swing high to this swing low is swing points, some kind of swing high, some kind of swing low, and then it's trading in the range, just like we said. And then a potential fractal swing point will occur that would be potentially bearish inside of a premium. So it's all very well, how to identify a fractal swing point, but does the fractal swing point occur in the correct direction? So you want to be looking for a fractal swing high in a premium and a fractal swing low in a discount. Okay, so hopefully, Emmanuel, that answers your question regarding the fractals of price. And obviously, if it's a fractal on a higher time frame, well, then that suggests that price has made a fractal swing. So like over here, candle 1, 2, 3, and 4. So candle 3 and 4, you can see, is making much more price that is lower than candles 1 and 2. So that's what makes the fractal swing over here. 1, 2, 3, 4. And that's a 4-hour time frame. So if price was to return back near the fractal swing, you can expect price to sell. And effectively, that's what it does over here. So this 2 is a fractal swing. Candle 1, 2, 3, and 4. So if candle 4 made a fractal over here. Okay, so there's fractals all over the place. It's really just a case of, am I trading the right direction, the right bias, based on the higher time frame? Where does your bias come from? Well, that's also something you'll learn, but bias would come from monthlies, weeklies, and dailies. That's where a proper order flow would come from, because anything lower is just intraday price action to grab and stop out everyone that's trading for scalps and things like that. So the higher time frame directional bias will come from monthlies, weeklies, and dailies. Okay, so does anyone else have any questions?
Nothing from my side, Darren.
Okay, Roger, with that, did you understand the part of identifying an impulse swing for example, say a daily chart, and from that impulsive swing, we are identifying that price sold or bought from that impulsive swing, and we can work within some kind of trading range from that impulsive price swing. Does that make sense to you?
Yeah, Darren, it does make sense for me. I think the takeout for me is when you look at those swing points in your premium or discount area, like you mentioned, That's something that I didn't, something that I know about it, but now that I started to plot them on the chart, I can see moves or swings better than what the market's doing.
Yeah. So what you'd effectively be saying is that whenever there's a fractal swing of price coming from a high down to a low, or coming from a low up to a high, we are looking for that impulsive price action to move in a particular direction to give us a potentially new trading range. So over here, for example, it would have made a fractal swing, and for whatever reason, maybe we didn't get in the trade over here, but then we watched the price action unfold. What has happened? Well, price has come from this high down. Well, where does it come from before it came to this high? Well, it came from this low. So we would imagine that price is trading inside of this range to this range, which makes us the swing low to the swing high, and then we're working within some kind of impulsive price action to the downside, so that when price sort of retraces, we can look for a potential sell. So the scenario would be that maybe we missed the sell over here and price traded lower over here, but we missed this, and for whatever reason, maybe life got in the way, but we missed that sell, and then we saw this sell to the downside over here. We would try and find ourselves that when price made this low and we saw this upward move, we saw the order flow was bearish, and we would effectively say that this whole area is premium over here. So when price returns into the premium zone, we are looking for reasons to be a seller from the impulsive move to the downside over here. So if there's no like impulsive move, then there's no really reason to take the trade when it returns to an area, because if it's just consolidating, then price may not want to do any sort of expansion, because that's part of what you learned about the phases or the stages of the market, that price would consolidate, and from a consolidation it would expand, and then when price has expanded from a consolidation, it's either going to retrace or reverse. So we see that price retraced and then price reversed basically over here. So it retraced to reverse and expand again. Because remember, consolidation, expansion, retracement or reversal, and then it can either go back into consolidation or it can just continue to expand. And then that's what we really saw here, is that little bit of a consolidation, depending on what time frame you saw it, but effectively it just went lower. And actually, where it went lower here is that level there. And what is at that level? Well, let's look here on the weekly chart. What is there? Well, there's this void there. Over here, there's a void here. Well, on this time frame, it's a little gap, but on a lower time frame, there would be a void here. And that's effectively what we saw here. So we would mark out that this whole area is a premium from that swing point. It sold off, and then price retraced back into this fair value gap at the same time, because this up close candle over here was then traded through by this candle down here. We would say that this is a bearish order block, and we could see and notify that this is a bearish order block, and you'll learn why that's an order block later on, but we're going to call that an order block for the reason that there is an upward move and then they sell, and when they sell there is also a void. So not every single engulfing candle is an order block. It's really a case of, if there is or potentially an order block at play, then there should be some kind of void that is created, and in that case there is one here. Okay, but that's effectively what we saw with price over there on EU. And if we were selling and we zoom out here, where would it likely go? Well, just like you guys learned, it's heading for liquidity. So where's the liquidity? Well, we can see that price made this low here, and that was an untested low. Why is it an untested low? Because when price traded here, it didn't go any lower, it stopped, and then it traded higher. And as price trades higher, more stops gather here, or sell side liquidity. And even here, when it retraced down here, did this low take out this low? No. So then in that case, people associate some kind of trend line to this, and they think that that's what the market's moving towards, and more liquidity would gather here. So when price came down here and failed to take out this low, what would have happened? Well, then they see all of this consolidation. They say, oh, it's reached support. So what do? They either buy it, put their stop there, or long-term buyers will buy it and put their stop below this low for price to trade higher. And then what does price do? It targets this low, doesn't show much in terms of reversal, and continues down lower here. And if we draw this out over here, something like that, we can actually see that it makes equal lows, relative equal lows over here. If I zoom in there, so there's the low over here. Here's the low. So this is your exercise that I gave to you guys on Friday. So here is a low. This is just based on a higher time frame, but it's exactly the same concept, is that this is an untested low, and price came down, took the liquidity of this low. What did it do with this liquidity? Well, it tried to go higher, failed. So that, what does that mean? That traded lower, it retraced and expanded again. So it retraced and expanded into what? Into liquidity, because while it did not take this low, this is for retail traders support, and because this is support over here, if we look there, it didn't take the low, so it made equal lows, and people seeing this move over here will think that now this has reached support, so they'll try to buy this or wherever they'll buy in here, and they'll put their stop below here, so more liquidity will gather. And then even over here, more liquidity is engineered by doing this, making that low over there, making further confirmation to retail traders that that is now a buy. Price retraces, one green candle, that breaks the high, so obviously there would be breakout traders, and then boom, what does price do? It rejects and sells off. Why? Because the order flow is bearish. There is liquidity down here. What, let's see who's on here. Temetope, what is the reason for why the market does what it does? What is the number one force behind the marketplace of whatever it does? Why does it move to where it moves? What is the reason?
Is it that wherever there's a seller, there's a buy, like balancing out the market?
Well, yes, but in terms of like why it goes where it should go. Like, is it because of the structure? Is it because of the order blocks? What is it doing? What it's doing? What is the
I
market?
understand the question.
What is the market driven by?
I would say liquidity, but that would be guessing. I'm not sure of the exact answer.
No, you're correct. That's
Oh,
exactly
okay,
right.
yeah.
So the market is driven by liquidity, both short-term and long-term liquidity. And that's why it's important to understand this whole development phase of understanding the market as a market maker, or through the eyes of a market maker, and the story behind liquidity. So like if we know that there's liquidity there and price is now traded into this liquidity, we know that there was orders down here for sell side liquidity. So what would be important to understand here is, now that we knew that price should have sold in here, what do they do with this liquidity now? Because they've raided the liquidity. Is it a case of when they take this liquidity, do they reverse price, go high and start to, you know, break swing points of these highs and these highs? Or is it just a case of grabbing the liquidity here, retracing back to maybe some sort of inefficiency, only to expand then lower over here? So the number one driving force for whatever moves in the marketplace is driven by liquidity. That's why you understand what those three institutional reference points are, which are what, Roger? What is the three institutional reference points? Roger is muted. So anyone else want to answer what they think the three institutional reference points are?
I
Is
can
it,
just take a
order
call
block?
for it. Oh, sorry.
Sivakaran, you were first. Go ahead.
Okay, I think institutional reference points are order block.
No, in order. In order. There is an order. It's not just, you know, whichever of them. If there's
Okay.
three of them, there must be an order to them. So what is the first one?
Is it imbalance, fair value gap, and order block liquidity?
Okay, well, you've mentioned two of them, but they're not in the right order. Does anyone know all three of them and in the correct order? Mashoto, do you want to give it a try, if in the correct order?
Yes. Yeah, let me try. Is it the old highs and lows, then order block second, and then liquidity voids or fair value gaps?
That's 100% correct. So if we look at how price is structured, so now let's think about this again, right, guys? If we understand the market is driven by the sole driving force, which is what we label as liquidity, okay, and we have what we now have understood as the three institutional reference points, then don't you think these three institutional reference points, as a byproduct of what the market is doing according to liquidity, is structure, right? It creates structure then, right? As what we think we know what structure is. Not so? Because why? It trades higher over here. So it makes an old high. Then it makes an order block over here. And as a chain reaction of making an old high, selling into the up close candle, it has made an order block, and because they sold into this up move, then this has become a void or a fair value gap. So it seeks liquidity, it grabs the liquidity, and in its wake leaves behind the old high, the order block, and the void over here. Do we see this, guys? Does anyone not understand what I'm explaining right now? Because this is sort of just the foundation of everything you're going to do in the future. If you don't understand this, you need to speak now. Does everyone understand what I'm explaining?
Could you go over that one more time for me, please, Dara?
Okay, Temitope. So for whatever
Thank you.
reason, price trades lower here, and for whatever reason, over here, it stops going lower. Okay, but we said that if we zoomed out, it sort of didn't go any lower to manufacture or engineer new liquidity over here at this swing point. Would you agree with that, Temitope? Temitope, would you agree with that? That there was an engineer, your mic is muted if you're trying to speak.
Sorry, my Wi-Fi was just cutting up, but yes, I see the first.
So it engineered new liquidity over here by moving to the upside. And if we look at this weekly chart and we zoom in a bit, every up close candle has basically become an order block. So what does that tell you about the order flow of where price prior to this rallying for 2 weeks? What does it tell you about the overall order flow?
That it's bearish.
So if the order flow on the weekly is bearish, okay, don't you think that intraday order flow can still change to go bullish, like 1 hour, 4 hour, potentially daily? That can still go bullish, right?
Yeah.
But does that mean that the weekly's order flow has now changed just because the 4 hour, the 1 hour, and the daily's gone bullish? Does that mean that the weekly's changed?
No, because the
doesn't.
higher time frame will govern the lower one.
Exactly. So then, understanding that, if price manufactured more liquidity over here by not taking out the low and retraced over here, manufacturing more liquidity, retracing over here, and we now, let's say, if we zoom in here, we said that, oh, well, there was a void over here that it closed and then it sold. But let's say we missed that and we said that, well, we wanted to be a seller here, but we weren't at our PC at that time. And then the following week it sold off. Well, that's no problem, because what happens? It creates an up close candle, this swing point high over here. So what does that mean for this candle over here? That means that this has now become an order block. Even though it's not the very next candle, that doesn't mean that it's not an order block. That just means that it took another week to make this order block. All of those buyers became sellers, making that an order block. So this is an old high. Notice how that fractal exists over here. At what? A previous institutional reference point. This is an institutional reference point. Just because there is no order block right here does not mean that that is not an institutional reference point. You can have an old high and an order block and a void right next to each other, but you don't need all of them present to say that one of them is an institutional reference point, because at the closure of this void that was created here is an institutional reference point over there. So a fractal swing occurs at an institutional reference point. They buy to sell, making an old high, an order block, and a void. So if we know that order flow is bearish, any retracement would be reason to sell. Sell into what? Into liquidity. So this is how it is created. Liquidity, order flow, structure. Those are the three, how the market's driven. So it's not structure. The market doesn't move because of the structure. It moves because it's seeking, engineering, destroying, or creating that liquidity. And as a byproduct of the liquidity comes which direction it's trading based on the higher time frame, which direction it's going. And then the structure is created because of the orders. The banks or the institutions don't sit and say, oh, well, here's structure here, and there's a swing high here, so there's this bullish structure, so we're going to take trades over here because the structure is bullish or whatever. They're not taking or engineering trades based on structure. They're engineering trades based on liquidity, of where they can take trades, exit trades, enter new trades, or add to their trades. The market is driven solely by liquidity in the direction of the order flow. And because of liquidity and order flow, structure is created. What is structure? Well, structure is this swing high, this swing low, that swing low. Market broke structure, so everyone's jumping on to sell, and that is structure to them. But they don't understand why structure is structure. And this is why structure is structure. Is because of the orders that are taken and the three institutional reference points. Does that make sense to you now, Temitope, or not?
Yeah, that makes sense. Thank you.
Okay, so understanding that, guys, and understanding what we should have understood about if we took a chart like anything and we mark up liquidity, okay, our exercise was to mark up swing highs, swing lows on the 4 hour, the daily, the 15. And it is your homework to work with what you've marked up and watch when price trades into those points of interest. So for example, there is a point of interest over here. Why here? Because this is all of this consolidation. So there would be a gathering of liquidity underneath this consolidation, and that would be a target for price. So on a higher time frame, even though the order flow is still bullish on Euro GBP, it is targeting liquidity over here. So it is our job now that once it's taken this liquidity, what is the story behind price? Does it now want to move away once it's taken this liquidity, or does it want to reverse above a recent lower time frame swing high? Because there'd be liquidity over here for breakout traders over here. So if price was to trade higher, does it want to reverse and then take out this low down here? And when it takes out that low, does price want to reverse again? What is it doing with the associated liquidity? And the liquidity tells us the story of price on any time frame, on anything that you want to trade, any time of the day, on any chart, on any asset. It seeks liquidity, whether it be stocks, bonds, commodities, whatever it is that you want to trade. So anytime there is a high or a low, you must understand that it is trading towards or wanting to seek liquidity. So for example, when GU over here failed to take out this liquidity, but took out this liquidity over here, it then reversed under that liquidity. And if it was going to go bullish, then this liquidity that was grabbed below this swing low should have taken out all of the swing highs. However, it failed to only really go through here, not even there. And then boom, price decided to go back down. So now more liquidity has been gathered where? Over here, because as price goes back up, more liquidity is gathered here. But there's no point going just here and leaving this liquidity over here. So then it is our job to pull this across and say, well, now the fact that price did not take out these lows and left this low, untested liquidity means that price has got now what we refer to as a DOL, so a DOL, which is a draw on liquidity over here. So it is very likely that if it is going to buy this week, that it would only likely want to buy underneath these lows. Now, I'm not saying that it's going to only do that, but it is a high probability scenario that if it's going to go lower, it's going to at least target this one, and then possibly think about reversing. And this is GU over here. And the reason for that would be because something you'll learn in the future: internal range liquidity, external range liquidity. So, you know, there's a story behind why price does what it does. Okay, so I'm not going to go into too much detail about internal and external range liquidity, but just know that it exists in the marketplace. So over here you had a swing low like this one and this one. So swing low, swing high, price failed to take out this high, which is internal range liquidity. So when you trade internal range liquidity, you go external range liquidity. So again, we traded internal, so now our target should be external. So this would be external structure or external liquidity on a 15-minute time frame. But you'll get better at this, but just understand where the liquidity is. That's the process of understanding liquidity in the marketplace. Okay, so we've got a couple of minutes here, and so I'm just going to quickly recap as to what it is that you've learned. So hopefully everyone is still continuing to learn the abbreviations on the chart, because that's effectively what you should be doing. You should have all understood what the market conditions are. Like we said, old high, old low, order block, liquidity void, or fair value gap, or buy side imbalance, sell side inefficiency, or sell side imbalance, buy side inefficiency. That's basically either a bullish fair value gap for a BISI or a bearish fair value gap or liquidity void for a, a sell over there. So SIBI, BISI, that's just like an interchangeable term that we use to identify if it's bearish or bullish. And that's what we've really learned thus far, which lays the foundation of what type of condition we are in for the marketplace. And as to, before the market does anything, trades into an order block, makes a swing high, grabs liquidity, this is what it's stuck in, is these phases of the market. And we can identify which phase the market is in, and based on the phase, we can say, well, if that's the phase it's currently in, where is it likely to go to? And when it gets there, what could likely happen next? So obviously, if, like we said, that the weekly was bearish, but then daily and 4-hour go bullish, well, then daily and 4-hour trade into weekly bearish, meaning you'd have to wait for lower time frames to go bearish, and then the order flow continues. That's all that really is at play all the time. Okay, so hopefully you've continued there, and then we talked about impulsive price action, and we said that the banks are the people who, or the entities or institutions that move price of a currency, but that's not only specific or limited to currency, it's basically any asset that is in the market for exchange. They have a handle on it, and we said that if there is such a thing, there's not millions of people sitting behind telephones capturing orders. It is run by an algorithm, and that algorithm is referred to as what ICT says as the interbank price delivery algorithm, because it's electronic. And if it was manual, well, then price wouldn't be as efficient as it is now. And if you go look at charts from like 20 years ago, you'd see a lot of inefficiency as opposed to now. And that is really the driving force as to how the market works. Okay, we don't have to get into too much detail about that, because that's just how it works. You don't have to know it, actual, algorithm. Just understand that there is one, and that is how price is delivered. The algorithm delivers price, not, people phoning each other, telling them to buy and sell, like you see in the movies. It's all electronic now. You know, back in the day, it wasn't even available to us to log into our MetaTrader on our phone or whatever platform and take trades from our phone, because you had to call your broker and then they would give you the ask and the bid price of whatever asset you were trading, and then there'd be a spread, and then we'd be able to take a trade like that. Now it's obviously efficient and it's all done electronically, and your orders processed within minutes. Back in the day, it took a couple hours just to take a trade on, you know, whatever you were trading, copper or gold or whatever they used to trade. Then you're part of your development process. That was to identify the highs and the lows of those time frames, if not all of the time frames, really up to you, but at least two of them, and basically identifying where the market moved away quite aggressively, making voids, and where there would be sort of untested highs and lows, and identifying equal highs and equal lows, or relative equal highs and relative equal lows, and what days do the high of the week and the low of the week form. Okay, because this is an exercise. Before I tell you the answers to these things or show you how to use this information, it's important as newcomers to the marketplace to understand the existence that price is moving towards the liquidity, and the driving force behind the liquidity is the London and New York sessions mostly, and you know, that's the operating hours of the bank, and that's where price is, you know, most volatile, except for obviously news and things like that. But that's the reason for understanding what we need to understand about high of the week, low of the week, which kill zone or which session it forms, and if it's on a Monday or a Tuesday or a Wednesday, what kill zone or what session does that high or low of the day form. You know, once you start to understand these really basic things about the practice of the marketplace, then we can elevate ourselves with, you know, confirmations and, you know, SMTs and COT datas and seasonal tendencies and all of that other jargon. But if we don't understand the really basic stuff and how I've structured it here, it's going to be quite difficult, you know, for us to understand everything. So, okay, I'm going to have to make a new session now. Alex, are you here? Or maybe it's not possible for you to talk. Okay. No problem. So I'm assuming everyone's got the homework idea behind them and the purpose of it. Emmanuel, you got a question? No question. Okay. So I'm going to continue on, guys. This would be the next step in understanding what we need to do now that we've understood what, you know, we needed to learn so far. And hopefully everyone is with me, because I'm giving you this information as you are supposed to learn it, so that each phase that we learn or each session we progress through, we have a better understanding from before, and you're taking each lesson as a building block for the next lesson, because we will refer back to the knowledge of, you know, the very first lesson, the second lesson, back or in the future of lesson like 9 and 11. So there's a lot of emphasis and return to the stuff that we learned way back in the beginning. So hopefully you guys are caught up and understood everything. Okay, so the next thing we are going to understand is liquidity runs. So that's obviously something that's very important to understand, and a liquidity run is quite simple. It's either creating a favorable condition to trade or a non-favorable condition to trade. So it's rather simplistic in the approach of the identification, and I'll just shed some light on that for you guys. So first of all, what is liquidity? Well, areas we can identify on the chart where price can be bought and sold quickly without affecting the price. So that's like your swing lows and swing highs, old lows. It says here, areas where we can identify on the chart where price can be bought and sold quickly without affecting price. So why quickly without affecting price? Well, if we think like a market maker and we say that, well, if I've got 1,000 lots or 10,000 lots, sure, just 1 second. If we think like a market maker, you should see my screen now, and we say that we need to sell or buy 1,000 lots worth of whatever, GU or gold or whatever, as part of our process of repricing, we can't just do that at any level. So where would we take our orders or put our buy limits or our sell limits or exit the market or enter the market? Where would we put these orders where there would be a lot of orders to take back? So if we wanted to buy 1,000 lots, we would do it underneath where everyone else is selling. Why? Because while they are selling, they are buying our sell or selling our buy. They are taking the opposite transaction to what we are doing. So that is why there is areas where price would not be affected. That's why we say that. That is what liquidity is that if there is sell side liquidity, well, they can buy it or grab it in regards to the opposite end of the transaction chain. For every buyer, there's a seller. For every seller, there's a buyer. So whenever buy stops are triggered, you could sell to buy stops. Whenever sell stops are triggered, you can buy to the sell stops, because that is liquidity. And that is why we say, what is liquidity? Areas we can identify on the chart where price can be bought and sold quickly without affecting price. And it without affecting price emphasis is because if the banks have thousands of lots worth of currency or gold or whatever they're trading, they're going to affect price quite greatly. And if they do, then they tip their hand and say, oh, well, this is what they're doing, and then everyone's going to do it. So that's why they hide their orders where there's liquidity, and the market is driven towards those levels because that is where liquidity is. Well, yeah, that's the next one. Where is liquidity? Above old highs and below old lows. That's where the liquidity would be. And that translates into all the time frames. It's not just daily charts and 4-hour charts that have liquidity. Even the 1-minute swing highs and lows have got some kind of liquidity. Okay. So what we're going to learn now is the 2 liquidity runs over here. And these are quite valuable to us. Why are they valuable to us? Because they create, like we learned about consolidations, expansions, etc., environments with which are favorable and non-favorable to trade. Okay, so generally the market does something like this, let's say, and it's just sort of either ranging or trying to make highs, but then it reverses and goes back down. This is what we refer to as high resistance liquidity. Okay, so in terms of if price was to break down here, okay, for price to come back above this highs here requires a lot of money to come back here. So they refer to that as a high resistance over here. When it's above this level, this is high resistance over here. So the likelihood of it coming above there is high resistance, whereas the likelihood of this scenario unfolding down here is low resistance over here. So price has broken and expanded down over here. So if it retraces back up, this is a low resistance liquidity run. Okay, why? Because there'd be liquidity over here below these lows, and maybe if price came from a previous swing, maybe there was some liquidity on the way up like that. So underneath all of these little mini swing lows over here, there'd be liquidity, and price is drawn into these liquidities over here, and we refer to as this area here as high resistance, and this area over here as low resistance over here. So the high resistance, low resistance is 2 types of conditions that we would see. So you learned about consolidations, expansions, etc. But then now this is putting an emphasis on that, is that if it is doing what it looks like it's doing based on the price action, when it retraces, we can trade that low resistance liquidity run, because that's the favorable of the 2. We don't want to be trading high resistance liquidity runs. We want to be trading low resistance liquidity runs. So basically what low resistance liquidity run means, I'm going to put more emphasis on that one because that's the one we'd like to be trading, is that when there is liquidity, so where's the liquidity? Below that low, and then price comes back down, goes higher, and goes like this. So as price is going up, it's generating liquidity over here, maybe it makes another low over here like that. And generally the market can sometimes move like this, and as it's going up, it's obviously come from a low and now it's going to some sort of high or premium, and underneath each of these lows will lie liquidity. And for whatever reason, maybe there was an order block on a higher time frame, maybe there was a void that needed to be closed, maybe a rejection block, mitigation, whatever the reason, okay, the price traded into a higher time frame and starts to sell off. The low resistance liquidity run is when price takes all of these lows and shows no remorse and just grabs them. This area here would likely be a void created, and that is our favorable trading condition of a low resistance liquidity run. So you can think of the low resistance being that no one really tried to buy it and it's sort of just one way move to the downside. Obviously it will just be reverse if it was a buy, and the liquidity run comes from over here where all of this liquidity over here was gathered. So generally, if it was going to reverse, it should have reversed underneath some of these liquidity points, but instead it just blasted straight through them. And that is a liquidity run, a low resistance liquidity run over here. And that is a favorable trading condition. Now, in a similar environment, I'll show you an unfavorable condition. Let's say price did something similar over here and moved something like this, a little bit sideways, then higher, and then it started to sort of just range over here like this a little bit for quite some time, like this, and then eventually price decided at some point it expanded outside of that liquidity over there. This part here would be the low resistance, and this part, sort of this whole area, is the high resistance part. As the common term of support becomes resistance or resistance becomes support, that's not what I'm teaching you here. I'm teaching you a favorable condition that you should look for in the marketplace. And especially is if price expands in the direction of the bias that you anticipated. So if your bias was to sell and now price is creating this low resistance liquidity run to the downside, then all you need to do is, you don't want to be jumping on and dogpiling on this just to catch any move. You want to wait for price to retrace and then be a seller for price to take it lower down here. And there's a whole bunch of other things at play here, but really I'm just showing a favorable trading condition, which is the low resistance liquidity run. So where would the liquidity be? Down here, over here, over here, over here. Price blasts through that with this move down here, and that is a low resistance liquidity run. And when price runs back in here, this is high resistance. So it could possibly still trade higher, but it's much easier to trade the market in a low resistance environment than it is to trade it in a high resistance environment, because price, instead of selling here, and it was in fact bullish, it may take some time. It might reverse here, go down, come back up, go a little bit higher, and sort of just trade a little bit sideways before eventually going up to take out the liquidity above these highs here. So it may still go higher, but really what I'm showing you is that the low resistance liquidity run is where we want to be trading and not the high resistance. So We can trade the low resistance liquidity run as a reason to get into the market, but we can also use the low resistance liquidity run to get out of the market, because as we learned with the 3 institutional reference points, is that they would likely be occurring at these zones. So likely number 1 over here would be some kind of old high, maybe over there. So old high over here, and then possibly they bought before they sold, so some kind of OB would form over here, and because there was a expansion to the downside, this would be a void, so there'd be some kind of liquidity void or fair value gap in existence over here. So I'm not really showing you anything new other than a favorable versus an unfavorable identification of the chart. So we can go and look at this, and it's sort of an emphasis on what we said about the impulsive moves on the price action. Okay, so let's have a look at this, and we can just grab sort of any chart here. Let's do something I don't normally do, which is USD CAD and a low resistance liquidity run. So basically what we are saying about the low resistance liquidity run is, let's just see an area here, and obviously below this low sits liquidity over here. So when it takes the liquidity, is there like a long wick? No, not really. Does it, when it gets there, take the liquidity and continue to expand lower? So if we drew this out in time here from that low, when it gets there, it retraces but expands through it. And then again, well, if that's liquidity, then so too is this down here. When it gets there, does it expand through it? Yes, it expands through it. So when it's retracing back over here into maybe a void that was created, into maybe a order block, or maybe grabbing liquidity above an old high, that's when we want to be selling it again, because it's already tipped its hand that it wants to expand through the lows. Okay, now you see this and you say, well, if I had been a seller here, it would have really only been sort of around here down to here, about 80 pips. Okay, but if we think about what we are looking at on the chart, we have not applied anything else. So what you've learned about consolidations, expansions, retracements, reversals, and what you learned about premiums, discounts, we haven't applied that here. So when you apply to a low resistance liquidity run, where is premium and where is discount, then it helps you. Okay, it helps you substantially, because then now if we are getting a low resistance liquidity run that's blasting through the sell side liquidity in a premium market, then that can be a good sell setup. Whereas if it was sort of down here in the discount and it was blasting through the lows with a low resistance liquidity run, but we were in a discount, then that is not a favorable sell. Okay, so we need to understand that what I said now about high resistance versus low resistance is that as long as we're in a premium market and we are getting a low resistance liquidity run, that assists us in identifying a sell setup. But if that low resistance liquidity run is in some kind of a discount, then those are likely to be a turtle soup grab, because instead of price coming from this low, price may have come from a low already, go down, trade up, grab this liquidity over here, and then reverse, making that not really a low resistance liquidity run. You want to be grabbing the low resistance liquidity runs inside of the premium for a sell, and a low resistance liquidity run inside of a discount for a buy. How do we get the discount and premium? Well, that's something you learned first. You know, like I said about the impulsive moves on the daily, impulsive moves on the 4-hour, you are looking for those impulsive candles to give us some kind of discount and premium. Before I continue, does anyone have any questions regarding low resistance, high resistance liquidity runs?
Yeah, I've got one quick question, Darren.
Yeah, sure, go ahead.
Could you go back to the whiteboard picture diagram? Yeah, so this one here. So with these multiple like liquidity points, if you see that like sort of while as price, what if you're sort of tracking price action, you see multiple points of like of high lows, I guess we can call it. Is that indication that maybe a favorable sort of a favorable liquidity? Oh, sorry, I can't remember the keyword, but essentially that liquidity void order block that moved down after the purple section, is that a sign that that is coming soon, essentially?
Well, if we think about the condition or the characteristic that it goes into, so price obviously expanded over here, right? It expanded and then
Yeah.
it went lower. So price is then retracing over
Mhm.
here. It retraces over here, and then what? Then it goes back into consolidation.
So, yeah.
So then by identifying that consolidation, we just sort of sit on our hands and say, well, if we're a buyer, then we need to wait for like price to go out of this consolidation because we don't want to really be in the consolidation unless we,
Yeah.
you know, not too worried about being in consolidation. We're having a higher time frame setup and we're waiting and we're patient. But in terms of like scalping, day trading, intraday, session to session kind of outlook, you don't really want to be a part of that consolidation. Otherwise, it'd be like in profit, out profit, in profit, out profit kind of thing, break even, you know, that whole emotional roller coaster type thing.
Mhm.
So this scenario, if we were to zoom out here, price may have, so let's just delete this over here, come from some kind of high all the way back here, right?
Mhm.
So if that is the case, then maybe this would be some kind of discount because we would draw fibs from like this swing high to potentially some kind of swing low back here.
Mhm.
And then this would be some kind of equilibrium potentially over
Yeah.
here, EQ. Right now, if we are in
Mhm.
some kind of higher time frame discount, we don't really want to be selling, okay, unless we got the backing of another higher time frame when we're in a discount.
Mhm.
Does that make sense?
Yeah.
The low resistance liquidity run is to just say that if we're in a premium, it's a favorable setup that price sold, so then it should retrace and sell again. That's all
Okay.
I'm saying. It's that expansion, retracement, expansion that I'm showing.
Okay.
We don't really want to trade consolidations. We can trade consolidations like on a weekly because then that's a lot of pips in terms of 4-hour and daily charts. But
Mhm.
in terms of being part of that consolidation, depending on like if you're a scalper or day trader, you don't want to be a part of the consolidation. You want to be part of the expansion. You
Yeah.
want to just watch and be in the same place as you were yesterday, kind of thing. You want to either exit, lose the trade, or win the trade, or
Mhm.
break even. You don't want to sit in a consolidation. So having what you learned about the consolidation, expansion, retracement, and reversal, the low resistance liquidity run assists us to take trades that we may have missed because we weren't sure if it is going to take those highs or take those lows. So what I mean by that is if we look at a chart here, and again, I'm not illustrating right now, but this is what we refer to over here, at least for this time frame, as on this time frame would be external range liquidity over here.
Mhm.
But on a higher time frame, because this is 4-hour, this would be on a daily internal range liquidity because we came from this high over here and this low over here. So from this low to this high is internal in the daily, but on the
Mhm.
4-hour, this is a swing low and price traded lower than that swing low. So it is external on the 4-hour, but internal on the daily chart. Now I'm not going to get into as to, ins and outs of internal and external range liquidity because that's going to be what we'll learn next, but it's going to solidify our understanding of the high resistance versus the low resistance liquidity run. So
Okay.
over here is what we can say about it expanding lower, and then it's in reverse here. So when it expands through liquidity over here, over here, over here, this is low resistance liquidity run. Okay, we can still trade this because we can wait for retracement and then an expansion again, because that's how price would work. It would expand, then retrace, and expand again. So we are identifying that it's expanding through liquidity with a low resistance liquidity run, and then that can be a setup by itself. Like if this was it is a 4-hour chart, we could wait for retracement to get in again, potentially order block, breaker, void, whatever we would attached to this, but I'm not getting into the PDA part now. I'm just saying that we are identifying this as a low resistance liquidity run, low resistance liquidity run, but applying our order flow bias to what direction should be the low resistance liquidity run is what would separate this versus this. Because if price is bullish and we are getting a low resistance liquidity run, then price is just retracing only to go higher again. So it's going to create a low resistance liquidity run to take out the liquidity of the swing points most recent, only to expand higher. And that's sort of just a cycle that continuously unfolds in the marketplace. Is a favorable condition, it's expanding, it retraces or reverses. And this is sort of really just the groundwork of how we would find a setup on a chart. Because over here, we would say that, well, it came from this low to this high. So we wouldn't, even though we say that this is a low resistance liquidity run, we wouldn't want to be buying over here because this is now of this range and this low is a premium. So we would want to wait for retracement so that we could be a buyer. And just like I said, that if this is the swing low and this expanded over here, this is a low resistance liquidity run, we could wait for an expansion for price to retrace from here to here and give us anything below an equilibrium, something like this, which would be our discount of this area over here.
Cool.
Now, obviously, this is excluding anything that would be marked up on a higher time frame. So, like, I'm not including anything of that, but we can clearly see that the price expanded here on this daily chart. And when it came up to the highs of here, grabbed liquidity just over there. That's not enough to run the liquidity because that's only like 6 perps or so. So that's not enough to grab all the stops. So it would likely want to retrace back there. So that has actually now created equal, relative equal highs. So the order flow is still bullish. That hasn't changed. And buying in a premium, still valid, as long as it's in some kind of discount of the premium. So you wouldn't want to be buying at the premium of the premium, but rather the discount of this entire range. Because we have an entire range over here, which would put the discount all the way back here. But in terms of price getting there, it's going to have to get liquidity to get back down here. Because wherever price goes to or comes from, it needs liquidity to do that. So in order for price to get into this discount and close this imbalance or inefficiency, it would probably need to grab this liquidity first so that it can have the buy side liquidity to target sell side liquidity. And then on its way down, low resistance liquidity run. Because a low resistance or a high resistance liquidity run, specifically the low resistance, will only form generally in a discount if it's buying or in a premium when it's selling. It doesn't just happen. Only time it really just happens is when there's something of large impact, like an interest rate or like NFP. Well, not so much NFP anymore, it's sort of dead now, but interest rates specifically is the main market mover right now.
Okay.
So that is your high resistance versus low resistance, and that is the favorable trading condition over the high resistance liquidity run. Does anyone have any questions about what I've just explained?
I don't have a question per se. I was just wondering if we can make the colors of the Fibonacci a bit darker because I don't see it at all on the white chart.
Fibonacci is not actually something I normally use, but how about this? Is that better?
Can we make it a...
Okay.
I still can't see it.
I'll make it black for this specific video, but don't worry about too much about the levels. I just eyeball the discounts now that I'm used to it, but all I'm really doing is differentiating between what is discount and what is premium with the fibs. not to say that it's come
Premium.
to OTE
Yeah,
and I'm
okay.
buying because it's at OTE, for example.
All
But
right.
even here, so like if we were to zoom out here, when it took out the highs over here, so where's the highs? Well, it would have taken out all of this liquidity over here, and I think even more liquidity to the left over there. That's correct, over here. So it took out all of this liquidity. And when it took out this liquidity, what does it do with this liquidity? Does it target this? No. So it's failing to take out this low over here, which is this liquidity over here, and instead it's retracing into a discount, and then as it goes down low, we will get the high resistance versus the low resistance. Let's have a look at that on the 4-hour. So when it took out the liquidity here, oopsie, you could see how when it's in the premium and it does sell, it doesn't have a problem when it gets to swing lows, expanding through them. Do we see that? Like here. There's a low there, there's a low here. And when it has reached some kind of premium and wants to sell off, it doesn't have a problem. Yeah, sure, it takes the lows and then it sort of retraces before it sells again. But in terms of low resistance, it doesn't really do anything with this liquidity, because if it was going to do anything with this liquidity, then price should have just gone higher here, but it didn't. And then it expanded again. And even here, it just created that swing low. And again, what happened? Well, boom, it just blasted straight through this one over here. So that's what you want to see, is it expanding through that liquidity with the low resistance liquidity run. So I've got a couple of illustrations here just to solidify the understanding. But basically, it's all that's important to remember here is that easier order flow and low resistance liquidity run equals less structure, or less structure is easier order flow. All I'm saying is that you can trade whatever you want to trade and do whatever you want to do. It's just that there's less structure, there's less problems for price to, you know, reflect and bounce and consolidate when there is this low resistance taking place. When there's more structure, it becomes more difficult for price to, you know, do what it needs to do. So therefore, we have to wait for like a news event, or, you know, some volume to come into the market, or for someone to want to buy it. So generally, less structure, easier order flow is what we want to be applying ourselves to. And if we understand that, well, it's the exact same thing I just said. Once you establish order flow, bullish or bearish, there should be little resistance to raid liquidity of the recent swing high or recent swing low. That's what I just said. And we can see here that anytime there's that swing low that's present and we're in some kind of premium, we get the order block, it makes the old high and it expands lower. So when it grabs that liquidity, what's the story of price when it grabs that liquidity? Yes, it does reverse, it retraces a bit, but eventually the low that just grabbed this low over here also just gets expanded through, which is forming high resistance liquidity runs, meaning these little green crosses I've got here is forming high resistance, not lower highs and trend line patterns. That's not what I'm showing you here. I'm showing you that there's low resistance in the form of taking out the sell stops. It's low resistance. It's just trading through there. This one didn't have a low resistance, but eventually price did expand through it over here. Very little problem in the premium. And then I've got another one here. When it's taking out any swing low, low resistance liquidity run over here. Any of these lows as part of structure, boom, low resistance liquidity run. So for price to get back here, we can sell it when it gets back here or buy back into it as a retracement. Well, that comes from retracement and reversal. So either you buy into the retracement or sell the reversal. That's why you learned those things, reversal, retracement, because that's effectively how price moves. It's expanding, it's low resistance liquidity run. So either there's a reason to buy back this void, which is the low resistance liquidity run, or when it closes or closes the void or trades back into the low resistance liquidity run, you can expect selling to take place again. I didn't put a time frame attached to these because it's really fractal. So if it's 4-hour chart, if this is daily, weekly, 5-minute, it's the same thing. Low resistance, high resistance liquidity run. And obviously, as the one makes a low resistance, the other one makes a high resistance. I'm not showing you trend lines or lower highs. I'm showing you what you see on the chart in terms of price action, low resistance liquidity run. Here is a low resistance liquidity run, pretty easy to identify. It takes out all of this liquidity to the left side so that when it retraces back, it's retracing back into high resistance, and therefore not because it is resistance or whatever you want to call it, supply that it's selling. It's just because it's much easier to trade this environment than it is to try now and sell or buy up top here. That's what I'm showing you. And it's pretty easy to identify it once you've got the swing of things, but basically every low that gets taken, what is happening? Is it expanding through the low, or is it sort of rejecting and reversing below that low? Because if it's expanding through the low or expanding through the high, it's likely that that is low resistance liquidity runs. And when price retraces, that's when you want to be a seller or a buyer, based on, maybe an institutional reference point, when a void closes, when it retests the order block, or when it turtle soups the old high or the old low. And that's where our favorable market condition comes from. But it would be part of your homework just to go and practice it or look for it in the marketplace and send a couple of screenshots just so you know that what I've taught you here is effectively what your understanding should be of high resistance versus low resistance liquidity run. So we are looking for favorable conditions in the form of low resistance liquidity run. That is our favorable condition. Also applying that, looking for the swing highs, looking for the swing lows, untested highs, untested lows, equal highs, equal lows. What is the marketplace doing with those orders? And are we in a premium and are we in a discount? Because you're going to be targeting the lows in the discount from the premium, having sold in the premium. So then if it's in a premium, there should be a low resistance liquidity run into those lows. And that is a favorable trading condition. Any more questions, guys, regarding that? Anyone not see what's being taught here? Anyone have trouble understanding it?
No trouble from my side, Darren. Just maybe observation, you can correct me. If I look at like your highest liquidity runs, especially if the order flow is bearish,
Yeah.
That's where you, for me, it's almost like it's where the run goes against the flow of the market, which then becomes a high resistance liquidity run, and then it actually continues in the direction of the order flow, which in this case will be bearish. Like if I exactly what I'm looking at your example, but that was just my observation. Is like the trade is like the market goes against the flow and then creates a high resistance liquidity run, either by taking out a low, going into a void. It's just my observation, which is different to how I looked at it.
And you can also see that it came from some kind of low here, traded higher, 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 higher. So it would have likely come into some kind of premium, and then coming from down this low to this high would be in some kind of premium. And then now, if we're getting low resistance liquidity runs in the premium, we'd want to be looking for those swing highs, those old highs, those bearish order blocks, those sell side imbalance, buy side inefficiencies, or bearish liquidity voids, or bearish fair value gaps, essentially. And then that's how you trade the marketplace. Just a simple identification of these three things that we've learned: of the institutional reference points, the swing highs and lows of your development, of learning where liquidity would be. And now this is that if it is going to be bearish, then it's likely it's going to expand, and as a creation or as a byproduct of this expansion comes that order block of that swing high, creating liquidity and creating an order block and a void. And if it is expanding in the right direction and you are in the right premium or discount, you can basically trade it when price gets back there. So it sort of allows you to avoid being in a trade at not the right time, regardless of if it's New York session, London session, Asian session. If it's not a favorable characteristic that you can identify, then you just wait and you put like a price alert or a timer or whatever you're going to use for that. When price gets to those levels, then I can trade it. It's not a case of I'm just selling a market execution at current price, because it's going to go lower. It may go higher to go lower, or it may go lower and then higher, but you know, you have to just play the waiting game. And while you're waiting, you can go and identify these on your chart. And the purpose here is to say, you know, what is favorable versus unfavorable, because that's going to come when you are journaling. You want to be applying the right things for the right environment at the right time. You can't just be trading all the time, regardless of if your strategy says that I must take 10 trades a day. Well, it's not likely that the market could provide 10 trades, because not all throughout the day is going to be a favorable scenario for you to take a trade, to buy or to sell. And I'm helping everyone decipher what is favorable versus what is not favorable. Sure, you can trade anything, but if it's not low resistance, then it's not as favorable. Any other questions, guys? Because I'm going to go on shortly. Okay, seems like...
Oh, sorry, Darren, I was going to ask a question.
Sure, go ahead.
Thank you. So with the low resistance liquidity rates, they all seem to be, is this, well, I want to ask, it's kind of a two-part question. So the first part is that, is it always, or is it like the low resistance liquidity rates are always shorts because it's in a premium, or, and then that, so that's the first part. And then the second part would be, it looks like all of the low resistance liquidity rates are all shorts. So that's like the second part.
Oh, okay, no, then the answer to that question is no. Low resistance, just obviously this is just sell scenarios, but you get obviously the
Okay, cool.
reverse. So it will do a low resistance liquidity run to the upside. But the same rule
Okay,
applies,
cool.
is that it should be in a discount. If it's going to buy, it must expand higher than the lows, and there should be little problem for price to continue to expand higher. And that's it, guys.
Cool,
I'm going
makes
to
sense. Thank you.
rejoin shortly, so give us a 5-minute break. Temitopia, are you here? Temitopia?
Sorry, yes, yeah, I'm here, Darren.
Okay, so one of your questions, let me just share my screen quickly. Your question, let me just specifically mention this, is that you don't only get low resistance liquidity runs in a discount or in a premium or a bearish or a bullish one. You get both. So obviously as price moves low, below these lows over here and these lows here, price expands through it. This low here, boom, expands. Takes out all the liquidity to the left side, creates a new liquidity point, boom, expands through it. So what's happening? It's expanding through it with a low resistance liquidity run. And at the same time, while it's moving lower, it's creating swing highs, right? With more liquidity engineered over here, here, here. So as price is moving, it's making more liquidity, more liquidity, more liquidity. So as price moves lower and lower, we would expect that now not for low resistance liquidity runs to take place that are bearish, but rather the ones that are bullish then, because then in the same result, maybe for whatever reason, it's bounced off of this level. Maybe there was like a weekly order block or a weekly void or a daily something, and price decided to stop going lower here, but now return and go higher, and you know, maybe do something like this, consolidate and then expand. So over here would be more liquidity, more liquidity, more liquidity. So what we are saying now is that for the low resistance liquidity run to be reversed, it must expand through with no problem over here. Retrace, create new liquidity, and boom, expand again. So now it's starting to reverse its role, where to the downside or selling, it's having no problem trading through the buy side liquidity. So every time it's taking buy side liquidity, it's doing a small retracement and then just expanding higher, which is then a bullish low resistance liquidity run to the upside. At some point, you know, the market will change its direction based on 1 hour or 4 hour or daily. But that's essentially what we are saying. And then as it's in a discount, we can expect low resistance liquidity runs that are bullish to, you know, now not be bearish, but rather bullish because it's in a discount. And that's how you would read marketplace to understand what sort of favorable characteristic it's in. Is it in a consolidation? Is it expanding? And if it's expanding and retracing and reversing, are we in some kind of discount? And if it is in a discount or is in a premium, and we are identifying a low resistance liquidity run, we are marking up the highs and lows of the marketplace so that we know where potential targets of price would go to. And then we understand what institutional reference points are, because this whole move lower here on a higher time frame could have been avoided because it's just one candle going lower. So it's likely that it won't have a problem to blast through this whole big area of liquidity all down here. And like I said, with when it's in a discount, making a turtle soup in a discount above old highs won't have a problem. But if it's turtle souping in a discount, then the lows might be reversal points. And then that's how you'd differentiate from being a buyer to being a seller. And then obviously the low resistance just assists you to say, well, it doesn't have a problem blasting through. So it doesn't mean that we are buying at the premium over here. We are waiting for it to show its hand that it's creating a low resistance liquidity run to the upside, but we'll only be taking the trade when it retraces back into some form of discount.
Okay.
Like down here, and then show a reason to want to move away again from the discount to target this external range liquidity over here. And that's how the market is basically working all the time right now. So you can see this is a pair I trade the most, which is GU. So I trade mostly GU and EU. You can still see that every time a swing point is sort of being created, so like even now most recently, over there was a swing, over here was a swing, it came from one level of premium, and every time it's taken the liquidity, it's not really doing much with that liquidity, so it's not really reversing and then taking out the buy side liquidity, because that's what you would expect, is that if it's going to change, then it's going to start targeting the opposite side of the liquidity. So until it does that, and even over here, this would be a liquidity point, it's still not doing that. And even down here, it's traded below this low, so we would anticipate that price should retrace, and if it retraces, well, if it's not taken that high, then it's probably still going to go lower. So if it makes a swing low here and more liquidity is engineered here, then price will just retrace to trade back lower to use this drawn liquidity, because we can see that it expands with no problem in a premium through the sell side liquidity in a premium, and then when it gets to a discount, it expands through the buy side liquidity also with no problem, and then obviously it takes the liquidity, activates the buy stops, and then retraces, either to take more stops, because as it's retracing, it's engineering new liquidity to the buy side liquidity. And that's the story of price. Even over here in a discount,
Makes sense. Thank you.
over here, there would be a longer term liquidity point over here. You can see it trades lower, grabs the liquidity over here. It's come into a discount, so now we would still see expansion, but this is now longer a low resistance liquidity run, because we are in a discount down here, and we wouldn't want to be buying just yet until it then starts to reverse and expand to the upside through the buy side liquidity. So over there, over here, and then even over here, you can basically see it expands through it, retraces, expand, retrace, expand, retrace, expand, retrace, expand. And that's basically what the market just does over and over and over and over again. And if you can identify that, well, then you're sort of on the right track to, resolving problems that was maybe occurring. Was it you, Temitope, who did all of the months of ICT, or was it Walter maybe? I don't think Walter.
No, it wasn't. This is my first time, wasn't it?
Okay, so I think Walter's done full ICT, so he'd understand quite easily what I'm explaining here. But for newcomers to the understanding of high resistance versus low resistance might be a little bit difficult to grasp it at first, but the more you witness it in price action, the more it's easier to understand that there's a low resistance and a high resistance. And it's pretty much on any, even if we did gold, I know think it's Divakaran, he likes to trade gold, but I mean, it's really the same thing. Is that if we zoom out here onto a higher 4-hour and we look at where a price swing was, so whoopsie, where's this thing? So more recently, so price would have come from some kind of low over here, and then does it expand through the lows? So here would be some kind of liquidity below this low, below this low, below this low, this low. Now, generally, what should happen is that when it grabs the liquidity, we get a reversal, as we see over here. And then what happens? What does it do with that liquidity? Well, it trades to the upside over here, takes this liquidity. But then when it takes that liquidity, it makes a swing low over here. And we can see on its way down, every little swing point it's created is continuing to sell off, and all of these swing highs would gather liquidity, and all of the swing lows would gather liquidity. And when it's taking the swing low, what happens? It reverses, but does it take this high? No. And then when it takes this low, what happens? Boom, it retraces. Does it take this high? No. Well, then it just continues to trade low. So it's continuously targeting and attacking the sell side liquidity instead of the buy side liquidity. So therefore, we would be targeting sell side liquidity, and any retracement that looks like it's going up and reversing is likely just a retracement to expand lower again. And then that can be seen all the way to the higher time frame. If we look at what happened over here, it took out all of the liquidity to the left side of the chart. If you look at it from a weekly perspective, here would be the retail traders trend lines that they'd be drawing, and then boom, price expanded higher, targeting all of that sell side liquidity because of the touches of the trend line, something like that, or however people draw their trend line. But there'd be trend lines all over the place, and above all of these highs would sit buy side liquidity, and price failed to take out this high. And also down here would be sort of consolidation, so it's only natural for price to want to target the sell side liquidity after targeting the buy side liquidity. And then what do we get? Well, if we look at the daily chart, anytime there's lows, specifically over here, over here, over here, when it's trading into these lows, it's supposed to reverse. It does, but does it sort of, reverse and change the direction? No, it's just really retracing, only to expand lower again. And then when it makes that new low after raiding the liquidity, it again just expands straight through that low. So there again is low resistance liquidity runs in terms of swing low to swing high in some kind of discount and premium. So this whole section here would be premium, like that, and then this would be discount. And the closer we get to the discount, or inside of the discount, so sort of equilibrium is neither really premium, neither really discount, and it can still continue to expand lower or continue to expand higher. But generally we want to see expansions, and every swing point, either long-term swing point, short-term, intermediate term swing point, you want to see expansions through those lows, not sort of expand and then reverse and then target the buy side liquidity. You'd want to see it expand, maybe retrace a bit into the next order block or some other reason, and then expand lower. And then this is where what we're going to learn next about internal range liquidity, external range liquidity, PDAs, order blocks, propulsion blocks, mitigations. That's where all of this is going to come into play. But without understanding the storyline of price, you can't really say, what direction or what you think is correct without understanding this really basic stuff over here. So there'd be a draw on liquidity all the way down here, because they're just like there was a trend line here, there'd be a trend line over here with a whole bunch of liquidity, something like that, or however they would draw it, maybe like this, maybe there'd be liquidity there, and then price was in a premium from this swing high down to this swing low. It would be in a premium, so it's targeting sell side liquidity over here, and we can actually see that in terms of the daily and the weekly. So previously, this is a weekly chart. Over here, when price dipped below here, what did it do? It made equal lows here, which is over here, there, and there, equal lows. So by failing to take out this impulsive price swings low, engineered new liquidity, which made price retrace. What did it retrace into over here? Why did it make a high there? Well, if you don't know what your time frames are doing, you'd never know, but that is a monthly void over here. And the only reason why I know that is because I follow gold, and there is a monthly void that was closed right there. So that's where price retraced into. Higher time frame void was closed, and then boom, price is expanding lower. Low resistance liquidity runs on the lower time frames, and then that's basically the unfolding of price. So as price goes lower now, no longer will we want to accept that there is low resistance liquidity runs to the downside, but rather price targeting buy side liquidity. And if price decides to reverse right now, well, still you'd look for retracement, so maybe a retracement into this weekly SIBI that sits over here, and then once it gets into this little void that was created, potentially price may want to retrace. So price to trade higher here, close the void, take out all of this liquidity here and here, and then only to then go lower. Why go lower? Well, there's still more liquidity to be targeted all the way over here, which is here, here, and then more equal lows over here, which is the same as these equal lows. So there's more sell side liquidity to be taken at where current market price is, because if we look at the swing high to the swing low and the swing low to the swing high, price is though in a discount of the range. In order for price to go back up, we need to target sell side liquidity, because for every buyer there's a seller, for every seller there's a buyer. So that is the story of price. Any questions? Temetopia, I see you got your hand up again, go for it.
Yeah, so when these arrows here on the right, when you said that it's constantly like attacking the lowers and sort of rejecting the swing highs there, if you like see that while you're following track, or even if you've just gone back and seen it, I might be jumping ahead here, but how would you like use that for like gauging an entry or just get a trade or anything?
Well, you'd gauge it knowing the direction that it's pointing towards for either sell side or buy side liquidity. So like we said, that every time price is moving below lows and we want it to be a buyer and we buy, what happens to that buy? Well, it immediately buys, but only to retrace, only to expand lower again. So any sort of recent swing low that targets an long-term swing low sort of just gets traded straight through again. So if we were trying to buy this and we saw that it's just expanding straight through it, our order flow idea or our bias should change, because then now it's not expanding and creating voids in the direction we want to see. Because if it was bullish, then it should create voids to the upside, or order blocks and then a void to the upside. Whereas instead of it doing that, every time there's sell side liquidity, it not only grabs long-term sell side liquidity, but sell side liquidity in the short term, and then boom, it does that, retraces, and then boom again over here. So it's constantly attacking the sell side liquidity. So I'm just showing you the story of liquidity right now. So we haven't even attached, you know, like PDAs, equilibrium versus premium, and inside the equilibrium versus the premium, and the discount, like order blocks or voids or breakers, mitigations. We haven't attached any of that. I'm just showing you liquidity principles, you know, the basics of liquidity, because that's really the driving force. But when you couple the liquidity with the order flow, that substantially increases your chances, because then price comes from a low, creates sort of relative equal highs over here. We could say this is relative equal highs here. Okay, and any move above equal highs while the order flow is bearish, coming from this low, trading to this high, or these relative equal highs. So let's just pull a fibs there. This is a premium over here, like that, because this section here would be a premium, like that. So any move above an old high is considered a turtle soup in a order flow that is bearish. So like we said here, we're not looking at any other time frame except this daily, but what we did say was that there was a monthly reason as to why price also sold here, which is that void over here. There was that void. So if I mark up that void on the price action over here, and I like to make my voids purple like that, and then I just check that the low is right. So this low is 1871.51, and then that is 1871.51, 1871.51. So they are all right. And then if price comes in there like it did, I can anticipate a turtle soup above these highs, because the order block, or at least the void on the monthly, tells me it's a sell signal, so that any false breakout above an old high, there would be buy stops for everyone who thinks it's going to go and buy, because that's how they trade breakouts, which is also just a consolidation, expansion, and then a reversal above a liquidity pool, and then boom, price expands lower. And then when it expands lower, what does it do? It just retraces back into the low resistance liquidity run, which is seen here. See, so while we've marked up a higher time frame of this monthly, it's not precise the monthly, but we know that that higher time frame emphasis has got a big part or role for price to play in the coming days and the coming weeks. So although it pierces through the monthly sell side imbalance, it's taking out the liquidity and then it's reversing. And when it's reversing, it's expanding below the lows, creating a low resistance liquidity run. So we don't trade it because we're trading and we're selling at the discount. We are waiting for price to retrace so that we can sell it again. So we wait for price to retrace back into a premium of this low resistance liquidity run, and then potentially look for a sell. And that can be done from a daily, it can be done from a 4 hour, because here would be like a turtle soup, trade into the monthly void, sell off, and then retrace back into this daily order block over here. Okay. Okay, so I'm going to share with you now one of the first things that you learn, and it's one of the first things every ICT trader should know. And if you don't know it, it's fine, you'll learn it. But it's called a low risk entry. And it's one of the first things you learn as an ICT trader. And why it's one of the first things you learned is because it's in the succession of your learning process. So in order for you to test what you're learning, you need to have some kind of thing to test it against, to forward test it. And what you've learned so far about marking out highs and lows and liquidity points and expansions and premiums and discounts, what we are going to do is, excuse my crude drawing of an order block, but essentially it's really this. So I'm going to just draw an order block over here. So this would be a up close candle over here. And then if that's an order block that's bearish, this would be the down close candle over here like this. Okay, so that would be our order block, and then basically we'd mark out the order block that, this would be the void, this would be the order block, but essentially just the order block for now. That's really where the order block would be, so that if that's what the order block on the daily looks like, a daily order block, specifically the daily order block, we will wait for price to retrace back into this order block. And when it's at this order block, we will want to look for lower time frame liquidity pools for for buy side liquidity or equal highs or a swing high to be taken, so that we can be a seller for price to go lower here. And that is what we refer to as a low risk entry. We are using the daily bearish order block as a reason why we should see lower prices. And we're using the daily chart also because it's sort of a blend of not too low of a time frame, not too high of a time frame. And also there's a lot of transactions that take place from a daily time frame, and you can see a lot of the data from a daily time frame from an institutional perspective of where orders are. So the purpose is to learn this low risk entry, and based on what you already know about marking swing highs and lows, if price was to on a lower time frame trade into this order block, you'd essentially be looking for some kind of lower time frame equal highs, potentially like this on, say, a 5-minute or a 15-minute of this equal highs, knowing that this zone all the way over here is the daily bearish order block. This turtle soup above these highs will get you in the trade, and our trade setup is anywhere above this highs over here, and then we are looking to target price for a sell much lower, possibly at the low of the same day or a previous swing point or whatever the case may be. But the idea or the goal of this is to learn by forward testing where a potential setup is based on from what you've learned already. So this could be a low resistance liquidity run from a premium, and then we wait for price to retrace into the daily order block. We look on the lower time frame, so this would be your daily chart, and then this would be anything from, you know, M15 and lower, some kind of turtle soup that would occur, and we are looking to sell above the old highs. In the London session, in the New York session, we are looking to sell above the old highs for a turtle soup, and then we are selling, and we are looking to possibly maybe target any sort of swing low, maybe over here, oopsie, over here, some equal lows, maybe other lows, or any other void that you may find, or other, if that's a premium, you'd be targeting something in a discount. But the essential idea here is that you are using low risk entry. Low risk entry is one of the first, you could call it a strategy if you will, but it's really just a simple approach to taking some trades and practicing what you've learned so far, and that is turtle souping above some highs in a particular session, be it London or New York, getting familiar with taking sells when price is going up and taking buys for when price is going down. So it would obviously just be in reverse, is that this would be a down candle like this, forgive my drawing, and then this would be a green candle or whatever candle colors you use. That would be some kind of bullish order block, so that when price retraces back into this bullish order block, we are looking for a turtle soup on a lower time frame, something like this, maybe some relative equal lows, maybe like this, and then if price retraces into this order block, we are buying. Boom, takes the liquidity of these lows over there and over there, and then we are targeting maybe the previous day's high or some other void that we found on another time frame, or the recent swing high. Really depends on how big your risk reward would be, because maybe from taking these lows over here and reversing higher, this could be, you know, 60 pips, 80 pips, 100 pips. We don't know how much pips that's going to be, or percentage gain, but obviously risk reward would be applied here. So like 0.5 or 0.25% risk, and then targeting another institutional reference point, as you've learned, either closing a void, testing an order block in the opposite, or taking an old high in the opposite. So if you're buying, you're targeting a void that was created, an order block that was created, or an old high, one of those three institutional reference points. And then in reverse, if you're selling, you'd be doing the same. So that's what we should practice, because that is what is on the menu for today's practical, we could call it examination, is that you learn what low risk entry is, so that you can also use this to your advantage later on. Because when you learn the basic of a low risk entry, you'll see there's a lot of emphasis later on when we learn more about our PDAs, which is our premium and discount array. And in premium and discount, you buy in a discount and sell in a premium. So obviously, if you're buying a bullish order block, there should be some kind of discount. If you're selling a bullish or bearish order block, it should become some kind of premium. But it would be, because, you know, it's come from a swing high down to a low, it's retracing, and then you sell, or it's come from a low to a swing high and now it's retracing. So this is our practice for the week is that we are taking low risk entry, and I do have a document, a whole entire document or page, if you will. If you visit this Notion, I also think there's a PDF version of this, but basically why trade these setups? Well, these trade setups are based off of some kind of higher time frame. Large institutions or banks analyze these time frames, which is our monthlies, weeklies, and our dailies. But we don't want to focus on monthly and weekly. We want to focus on daily, and locating an area that aligns with our IOF, which is our institutional order flow. That's really what our goal is here. If you can see and understand what we've said about low resistance liquidity runs and voids that are impulsive moves coming from a discount or a premium, this is really what we are emphasizing now, is taking a low risk entry based on a turtle soup theory and applying some kind of daily bearish or bullish order block to that. And obviously, because it's higher time frame daily, it has more influence on price. The entry is based off of a higher time frame, and we're refining it down to a lower time frame. You're not limited to obviously using the daily and then going to the 15-minute. You must use the daily, only the daily, and whatever time frame lower than either 15, 5, and I guess 1 minute if you want to identify areas or liquidity pools. And the idea here is to practice this. It could be, obviously don't do this on a live account because you're still getting used to it, but what you'd essentially want to do is you're getting your risk factor charged up and ready to go for when you do go live in the coming months or coming weeks, whenever you feel confident. But it's going to help you by either mitigating losses, taking real actual trades that you're involved in the market, that excitement sort of phase, and dealing with the emotions of wins and losses, as well as placement of risk. Stop loss is whatever, 10 pips, and take profit is 30 pips. So then it's a 1 to 3. So everything that we've gone through, this is now the building block for taking some trades. You're looking for old highs and lows, depending on if it's a bullish or bearish order block. The daily OB must be above or below old high or old low respectively. So you can't just have a order block just sitting in the middle of nowhere on a daily or bearish or bullish order block. It must be in some kind of discount. And then, like I said, we should refine or define IRP exit points, which is institutional reference points. So if you're buying a turtle soup on a bullish order block in the London or the New York session, you want to look for a bearish void or a bearish order block or an old high. That's basically what we need to look for. And for the trade to be valid, there must be an old high or old low, or equal highs and equal lows. There you have to have that as a criteria. And using a suitable time frame and valid entry technique, we can execute the trade. So all that really means is you're going to use the daily to identify an order block. Then you're going to use the 15 or lower to identify some equal lows or a swing low or a session low or a daily low. And when a turtle soups that inside the bullish or bearish order block, you're going to want to be a buyer or seller when it's so basically you're buying because it's the daily or bearish or bullish order block, or you're selling because it's a daily bearish or bullish order block, and you're using the turtle soup for a reason to take the reverse side of the trade. Okay, so as an example, if we capture 60 pips of profits, depending on the size of our stop loss, this could be 1:3 if we were having a 20 pip stop loss. So if we had a 20 pip stop loss and price moves 60 pips, that's 1:3. If we had a 15 pip stop loss, well, then it would just be 1:4, and so on. If we had a 10 pip stop loss, it'd be a 1:6. So it's an easy entry technique. It's an easy identification based on what you already know. There's nothing new that you need to learn. And you can sort of start doing it like from today and throughout the week, but it's really to build that sort of what we've been speaking about over the last few weeks is coming now into the charts, and you can actually put it into practice, not just mark up hypothetical charts, but actually put your money where your mouth is, so to speak. If you come to the Notion over here, there is actually a actual whole document over here, and basically it allows us to see all the abbreviations that could potentially be used over here for taking a trade, basically, and how to do it. If you want that much explanation, you could come inside here. I'm not going to go into detail as to how to do everything. If there's anyone with any questions of how to do this low risk entry technique, you should either message me, email me, telegram me, or ask me now when I'm finished explaining. But this is what we need to practice coming into Friday and building confidence. That's why you needed to have watched my YouTube videos, because you now know what a bearish order block on a daily would look like. So it shouldn't be too difficult. And if anyone has any questions, you need to ask now. Does anyone have any questions? Okay, so the silence is deafening. Okay, well, it seems like there's no one with questions, yeah, and there's a lot of people missing from the Zoom meeting. So whoever watches the recording, all you need to do is watch the whole recording and come and do this and put this into practice so that you can take low risk entry trades. And practice makes perfect. Applying what you've already learned up till this point and incorporating it into the low risk entry with a turtle soup in a particular London or New York session, and you would be buying or selling based off the bearish daily or bullish order block on the daily, using a turtle soup as a reason, another reason apart from the daily order block, and then you'd be taking a buy or sell. And that is it, guys. No more questions, hopefully. Okay.
Thank you, Darren.